Stop refreshing dealer websites. Stop watching the spot chart like it's telling you the truth. Because the story today isn't the number on your screen. It's the number being paid off screen behind locked doors by corporations that can't afford to wait for a dip. Here's the warning. The supply chain just snapped. And when a supply chain snaps, price doesn't trend. Price jumps. And I'm going to make a very specific claim educationally, using simple time compression math and market mechanics, why $80 silver next week is not a crazy headline. It's a plausible outcome if the same acceleration pattern continues and if the paper market loses control of the next key level. In this emergency breakdown, I'm going to prove the time compression pattern is real and accelerating. I'm going to show how the physical premium is the true price signal when retail goes empty and industry outbids everyone. I'm going to explain the $75 gamma wall, why that level is the trap door that can launch price toward $80 fast. And then I'll give you the roadmap, what to watch, what breaks first, and how the market behaves when paper lags physical. The supply chain snapped, the tempo is accelerating, and $80 isn't a fantasy, it's mathematics. This is the Wednesday warning you need to hear before the next session opens. Let's start with the data, because it's the cleanest argument you can make without needing any secret information. The time for silver to move from $40 to $50 was 39 days. The time from $50 to $60 was 12 days. And the time from $60 to $70 was 13 days. Listen to that again. The move from 40 to 50 took 39 days. Then the market compressed time. It did 50 to 60 in 12 days, and 60 to 70 in 13 days. That's not a smooth trend. That's a phase change. And time compression is what markets do right before they break into a new regime. Because the higher the price goes, the more participants become forced buyers. Industrial users, hedgers, shorts covering, option market makers hedging. All of them shift from I want a good entry to I need inventory. Now, if we take the most recent tempo, 12 and 13 days, that's roughly 12 and a half days per $10 move in this phase. So what's the simplest projection? If the market repeats the latest rhythm, $70 to $80 can happen in approximately 12 days. Now, here's why next week is suddenly on the table. Because markets don't move in calendar perfect blocks. They move in bursts, triggered by levels, liquidity pockets, and mechanical hedging. And the next mechanical trigger isn't $80, it's $75. But before we get to the gamma mechanics, we need to understand why this compression is happening. Because it's not just chart patterns, it's physical reality asserting itself. Each $10 move is happening faster than the last because the market is discovering something terrifying. There isn't enough silver, not at current prices, not in the time frames industrial buyers need. And when scarcity becomes obvious, time compression accelerates. The $40 to $50 move took 39 days because the market still believed supply was adequate. Buyers were patient. They waited for pullbacks. But by the time we hit 50 to 60, patience was eroding. 12 days. Why? Because some industrial buyers started realizing they couldn't wait. They had to lock in supply. And 60 to 70, 13 days. Even faster tempo. Because now it's not just early movers, it's a broader recognition that supply chains are breaking. Delivery times are extending, premiums aren't collapsing, and the only way to secure metal is to pay up and pay now. This is the signature of scarcity behavior. Each leg happens faster because each leg removes more doubt. And once doubt is gone, once everyone realizes it's a race for limited supply, time compresses violently. This is why $70 to $80 in 12 days or less isn't crazy. It's the logical next step in an accelerating pattern. But here's the key. The pattern doesn't just continue on autopilot. It needs a catalyst. And that catalyst is sitting right above us at $75. In part 2, we're going to explain why the physical premium is the real price signal, and why when you hear rumors of $82 physical bids while the screen shows 73, you're not watching a normal market. You're watching a market in the process of breaking. Stay with me. We're going into the mechanics of the split. If you're just joining us, we've established that silver is moving in time compression. $40 to $50 took 39 days. 50 to 60 took 12 days. 60 to 70 took 13 days. Each $10 move is happening roughly 3 times faster than the previous leg. In part 1, we showed the pattern. In part 2, we need to understand why the physical premium matters more than the spot price. Because when the supply chain snaps, the screen price becomes an advertisement, not a settlement. Let me explain what's happening in the real economy right now. Retail demand is emotional. It surges. It fades. Industrial demand is non-negotiable. If factories can't source silver, production stops. And when production stops, the cost isn't a higher premium. The cost is lost revenue, broken contracts, missed shipments, and lawsuits. So when corporations need silver, they don't wait for spot to pull back. They pay whatever clears immediate delivery. This is why the $82 premium claim hits so hard. It signals a world where the price chart is lagging reality. In that world, the spot price is a fiction. Physical is being bid like it's already $82 or higher in the real pipeline. Here's the educational part your brain needs to lock in. When physical is scarce, the market splits into two worlds. World A, paper, futures, ETFs, synthetic exposure, contracts that can be settled in cash, and liquidity that can be created. World B, physical, refinery output, industrial offtake, 1,000-ounce bars, real delivery, hard constraints. When the chain snaps, World B starts setting the tone. World A tries to follow, but it can't follow smoothly. Because paper markets have their own rules, margin changes, position limits, halts, liquidation-only modes, rulebook risk. That's why you see the signature behavior of decoupling. Spot may wobble, but premiums don't come down. Delivery times extend. Dealers flip to pre-order language. Mints go on allocation, and the only buyer getting filled is industry. That's exactly why $80 next week becomes plausible. The moment the paper market gets forced to reprice toward the physical reality, the move isn't polite. It's violent, it's fast. And it leaves retail investors scrambling to understand what happened. Let me give you concrete examples. You go to a major dealer website. Silver Eagles that were in stock last month now show expected delivery March 2026. That's not a logistics problem. That's a supply problem. You call a refinery. They say, we're only taking orders from existing industrial clients. That's rationing. You check premiums. Spot is $73, but physical coins are selling for $85. That's a 16% premium. In a normal market, premiums are 3 to 5%. When premiums hit 15 or 20%, it means the market doesn't believe the spot price reflects reality. Now, industrial buyers aren't calling coin dealers. They're calling refineries, miners, and wholesalers directly, and they're bidding off market, away from the screens, away from the exchanges. This is the shadow market. And in the shadow market, prices are higher, much higher. Because in the shadow market, you're not competing with speculators. You're competing with Samsung, with First Solar, with Tesla. And those companies have billion-dollar production lines that can't stop. So when you hear rumors of $82 bids for immediate delivery, that's not hype. That's survival pricing. It's what happens when a corporation realizes that saving $5 per ounce isn't worth risking a $100 million contract. This is the mechanism that breaks paper control. Because eventually, the paper market has to acknowledge what the physical market already knows. There isn't enough supply at current prices. And when paper is forced to reprice, it doesn't do it gradually. It gaps, it jumps, it resets. In part 3, we're going to explain the $75 gamma wall, because this is the technical trigger that can turn the compression pattern from fast to explosive. The level that can take $70 to $80 in days, not weeks. Stay with me. We're going into the mechanics of the cascade. We've reached part 3. We've shown you the time compression. We've explained the physical premium. Now we need to talk about the level that turns the 70s into a launch pad. $75. Here's the simplified educational version of gamma mechanics. A massive amount of call options tend to cluster at big round strikes. $70, $75, $80. When market makers sell those calls, they carry risk if price rises. As price approaches the strike, they hedge by buying futures. That buying pushes price up, which forces more hedging, which pushes price up faster. That's the feedback loop. So your time compression data gives us the tempo, but gamma gives us the ignition. If price starts leaning into $75 and the market senses that the wall is about to crack, you can get a move that compresses days into hours. This is how $70 to $80 can happen without needing a new story every day. The story becomes the level. Let me explain this with numbers. Let's say there are 50,000 call option contracts at the $75 strike. Each contract represents 5,000 ounces of silver. That's 250 million ounces of exposure. The market makers who sold these options are currently not hedged, because when silver was at $65, the probability of hitting 75 seemed low. But now silver is at 73. Suddenly, $75 is $2 away. The market makers panic. They start buying futures to hedge their risk. This is called delta hedging. They don't wait for $75 to hit. They start hedging as it approaches. So at 73, they might buy 20% of their exposure. At 74, they buy another 30%. At 74.50, they buy another 30%. By the time price actually hits $75, they've already bought most of their hedge. But here's the problem. This massive wave of buying, driven by dealers hedging their options, collides with a market that we already know has no physical supply. It's a perfect storm. The paper market is forced to buy, but the physical market has nothing to sell at these prices. So what happens? The price doesn't just go to 75, it blows past it. The dealers are now chasing the price higher, buying more and more aggressively to cover their exposure, creating the very price explosion they were trying to hedge against. This is the gamma cascade. It's a technical feedback loop that can make $75 to $80 happen in a single trading session. So let's put it all together. The roadmap. First, the time compression pattern tells us the market's metabolism is speeding up. Second, the physical premiums and delivery delays tell us the underlying supply is already broken. Third, the $75 gamma wall is the tripwire. What to watch? Forget the headlines. Watch the premiums on physical metal. Watch the dealer inventory levels. And most importantly, watch the price action as we approach $75. Does it slow down or does it accelerate? Acceleration is the sign that the gamma cascade is beginning. If we see that, $80 isn't just possible next week. It's probable. This isn't financial advice, but an educational breakdown of market mechanics in a crisis. The pieces are in place. The tempo is accelerating. We've shown you the time compression, explained the physical premium disconnect, and detailed the massive $75 gamma wall. Now, it's time for the roadmap and the warnings. Understanding the mechanics is one thing, but surviving the chaos is a whole other beast. So let's get straight to the clean roadmap you can follow with authority. Step 1, price pressures into the mid-70s were already here. As I'm recording this, we're at $73. Momentum is strong, and the pattern points to continuation. Step 2, market makers start hedging more aggressively. As we get closer to $75, that gamma hedging accelerates. You'll see this in rising volume, larger price candles, and a lot more volatility. Step 3, liquidity thins out, and the candles stretch. When hedging flows take over, normal market making breaks down. The spreads between buy and sell orders widen, and prices can jump $1 or $2 in mere seconds. Step 4, $75 breaks and triggers a cascade. Once that wall breaks, the feedback loop goes into overdrive. Hedging becomes forced buying. Forced buying becomes price acceleration. And that price acceleration triggers even more hedging. It's a powerful cycle. Step 5, $80 becomes a magnet. Why? Because it's the next psychological strike cluster. Once $75 is breached, the market looks for the next level of resistance, and $80 is the obvious one. If gamma is already engaged, the move from $75 to $80 can be shockingly fast. Step 6, physical premiums stay elevated. This is key. It confirms the real price is higher than what you see on the screen. Even if the spot price hits $80, physical silver might be trading at $90 or even $95. This decoupling does not get better at higher prices. It actually intensifies. Why? Because higher prices don't suddenly create more supply. They create more panic. And finally, step 7, the media wakes up late, retail investors pile into paper assets, and that decoupling stress gets even worse. This is when your neighbor starts asking you about silver, when the mainstream news finally covers it. But by then, physical is gone, and people are chasing paper products that might not even be deliverable. That's the logical chain, and it lines up perfectly with the data. Once the tempo compresses this much, the market stops moving like a staircase. It starts moving like an elevator with the cables cut. Now, for the tactical warning. When a move gets this fast, the system fights back. If silver starts ripping through $75, you should expect to see things like margin requirement hikes, trading halts due to volatility, talk about position limits and official language about disorderly markets. You might even see liquidity vacuums where the price jumps simply because there are no sellers. This doesn't mean the bullish case is wrong. It just changes the path. It makes it messier, more violent, and a much bigger psychological test. And that's why the phrase, "the supply chain has snapped," is so powerful. It implies the driving force isn't just sentiment, it's the raw behavior of a shortage. Rule changes can slow down the paper market, but they can't print physical silver bars. Let me be very clear about what you're watching. Your screen can say $73. Your chart might look completely normal. But when you hear rumors of industrial bids at $82 for immediate delivery, and you see the time compression accelerating, you're not watching a normal market. You're watching a market where the only real question is, how long can the paper market pretend the physical market doesn't matter? And the answer is becoming clear, not much longer. Every single day the premium persists, more people realize the disconnect. Every day delivery times get longer, more industrial buyers start to panic. Every day the tempo speeds up, more participants shift from being patient to being urgent. And once urgency becomes the dominant emotion, price discovery breaks. It doesn't adjust smoothly, it resets violently. So here's the Wednesday warning. We are at $70. The compression pattern suggests that $80 is about 10 to 12 days away at the current tempo. But that tempo can accelerate. If $75 breaks with gamma fully engaged, we could hit $80 in just 5 to 7 days, maybe even less. The supply chain has snapped. The physical premium is screaming, and the gamma wall is directly above us. This isn't a prediction. This is pattern recognition combined with a mechanical understanding of the market. The market is telling you what's coming. The real question is whether you're listening. If you're holding physical silver, you're positioned correctly. Your metal can't be hit with a force majeure. Your bars can't be cash settled against your will. You have the real asset and you control it. But if you're waiting for a dip to buy, you need to understand that those dips may not come. Or they might be so brief you can't even execute a trade. Or they might only exist on paper while the physical premiums stay firm or even rise. The window to get positioned is closing. We're not talking about months here. We're talking about days. Because once $75 breaks and that cascade starts, the next stable price level might be $85 or $90. Not because of speculation, but because of the combination of mechanical hedging, physical scarcity, and industrial panic. That combination doesn't produce gradual rallies, it produces explosions. So here's what you do. Watch the premiums, watch the delivery times, watch dealer inventory levels, and watch that $75 level like a hawk. If it breaks on high volume, the race is on, and $80 stops being a target. It becomes just a pit stop on the way to something much, much higher. Subscribe, because if $75 goes, we're going to be tracking every single tick of that cascade. The supply chain has snapped, the tempo is accelerating, and next week might just be the week the paper market loses control completely. Don't get caught watching the wrong signals. Watch what matters, watch what can't be faked, and get positioned before the elevator moves. If you want daily breakdowns like this, where we separate the paper signals from physical reality, subscribe, turn on those notifications, and stay close. Because if $75 goes, the path to $80 could be faster than most people can emotionally handle. Thanks for watching.